Welcome back to Let's Talk Audit and Assurance. You're still in the MCQ Marathon as we help you crack the audit code with questions for board exam preparations. And guess what? You're already in part 4 of this marathon. And same as always, 25 questions. One goal, CPA success. Let's get started. Our first question talks about how subsequent events affecting the realization of assets. So when we say realization of assets, this may come in the form of the disposal of the assets by selling and similar transactions, ordinarily will require adjustment of the financial statements under examination because such events typically represent. Now, even if we take out that section about the realization of assets, we just think about subsequent events that would require adjustment, or that which we call the type 1 event. We know that these type 1 events are those events which showcase conditions that already exist as of the balance sheet date. And so therefore, when we evaluate the scenarios or the situations presented to us in the choices, such as, for example, letter A, the preliminary estimate of losses relating to new events that occurred subsequent to the balance sheet date, take note that letter A refers to new events that occurred subsequent to the balance sheet date. As in contrast with letter B, the culmination of conditions that existed at the balance sheet date, then we get to see that under a type 1 subsequent event, the answer would then be letter B, bravo, when we talk about conditions that already exist at the balance sheet date and were eventually settled or realized after balance sheet date. This is a type 1 subsequent event. So if we talk about letter C, the final estimates of losses resulting to casualties, or rather relating to casualties occurring in the subsequent events period, so mean to say the condition did not exist as of balance sheet date, or even letter D, the discovery of new conditions occurring in the subsequent events period. So these do not represent conditions that exist as of balance sheet date. So therefore, the only answer we have for this number is letter B, bravo. Next, we talk about designing audit procedures. The auditor should determine the appropriate means of selecting items. Now, the means available to the auditor would include, of course, 100% examination. It is possible for the auditor to employ 100% examination in instances whereby you refer to populations where there is relatively low volume or low quantity, but with a material account balance, or when you talk about populations that are processed digitally with little to no manual interventions, the auditor can make use of the 100% examination. Audit sampling, of course, is another big yes, and we know audit sampling is very popular and widely used when conducting an audit. And of course, selecting specific items or specific item selection is also another way for the auditor to determine or to select items for testing, whereby the auditor determines or comes up with a predetermined set of criteria which will be included in the testing. So all of this will be a yes, and the answer, of course, is letter A, alpha. We talk about when should the management representation letter be dated. So ideally, the date of the management representation letter should coincide with the date of the auditor's report. This is somehow to seal the date where management, or when management acknowledges the responsibility, up to the date when the auditor also acknowledges their responsibility for the obtaining of sufficient and appropriate evidence. So the answer here is Charlie. Next, which of the following is the least persuasive type of audit evidence? And to this, we get to recall the hierarchy of evidence reliability. Now, this might sound common sense to most of us, but then we do call this one the hierarchy of evidence reliability, where we point out that between externally generated documents and internally generated documents, well, definitely externally generated are more reliable. Now, in the case of internally generated documents, then we get to see that those which are produced from a strong set of internal controls would be more reliable than those produced from a weak set of internal controls, or from a weak internal control system. Of course, evidence gathered from documents are more reliable than evidence gathered simply verbally or orally. Evidence that the auditor is able to gather for himself or to observe for himself or herself is more reliable than that evidence which was gathered only by inference. Original copies are, of course, more reliable than photocopies or fax copies. So that will somehow outline the hierarchy of evidence reliability. So in this question, we are being asked which is the least persuasive. So for us to see the least persuasive, we do have to evaluate all four choices, starting with letter A, correspondence between the auditor and the client's attorney. Letter B, computations made by the auditor themselves. Letter C, documents mailed by outsiders or external sources directly to the auditor. Or letter D, copies of sales invoices inspected by the auditor. So after evaluating these four, we'd be able to conclude that the least persuasive is of course letter D, because these sales invoices, as compared with Alpha, Bravo, and Charlie, which are all externally sourced, letter D, which is copies of sales invoices, other than the fact that they are copies, meaning they are not original. Second fact is that these are internally generated. So between external and internal documents, of course, external documents are more reliable. Let us now move on to the next question. And the next question states that the auditor is unable to reach a conclusion as to the propriety of management's representations. So in this case, because the auditor is unable to reach a conclusion, that simply means that this invokes the presence of a scope limitation. And we all know that when it comes to scope limitation, should the auditor decide to modify his opinion, then the choice of the auditor will be between a disclaimer of an opinion and a qualified opinion, or a qualified opinion. So the answer to this one is delta. Next, you are the auditor of November Company, and November Company is a publicly listed entity. Allow me to ask you to highlight that. November Company is a publicly listed entity engaged in the manufacture of autumn-themed bags. You are in the process of crafting the audit report, and you are contemplating on whether to include a separate section with the heading Other Information. What would be your most appropriate course of action? And to this, we recall our previous review in one of our MCQ marathons, which will remind me that if you haven't yet viewed the MCQ marathon 1, 2, and 3, you might want to pay those videos a visit. But in one of those videos, we did mention that when it comes to publicly listed entities, even the mere expectation of receiving the other information would already allow the auditor to use the heading Other Information. So if we evaluate the choices that we have here, we would be able to see that letter A is already the correct answer. Include the heading Other Information if you expect to obtain the other information, because November Company is a publicly listed entity. So there is no need for us to have actually obtained the other information. A mere expectation would already be enough for us to include the subheading or the heading Other Information. So let's move on to the next question. And the next question is about Scary Company. Scary Company has entered into a major contractual agreement with Creepy Company. As part of their agreement, Scary should submit audited financial statements prepared under the provisions of the contract. These financial statements are said to be prepared under A, and financial statements that are prepared under the provisions of a contract are actually what we call special purpose financial statements, because they are prepared under special purpose frameworks. So when we talk about special purpose frameworks, we think about financial statements prepared under the cash basis of accounting, or financial statements prepared under the tax basis of accounting, or in this case, prepared under the provisions of a contract. So these are what we call special purpose FSS, prepared under special purpose frameworks. Now again, be reminded that the framework used to present the financial statements, to prepare and present the financial statements, are disclosed or are required to be disclosed in the notes to financial statements. Therefore, if the auditor wishes to highlight the fact that the FSS are special purpose FSS, using a special purpose framework, then the auditor uses an emphasis of matter paragraph to point to the note or to highlight the note in the FS that talks about the framework being used by the client. So in this question, the answer is bravo. Next, Which of the following procedures would an auditor ordinarily perform during the review of subsequent events? Is it letter A review of the cutoff bank statements for the period after the year end? Or letter B, an analysis of related party transactions for the discovery of possible irregularities? Or letter C, an investigation of material weaknesses in internal control previously communicated to the client? Or letter D, an inquiry of the client's legal counsel concerning litigation. Now, one of the most common procedures we perform when we test for subsequent events is to send letters of audit inquiry to the client's lawyers. And so, therefore, the answer to this one is delta. Now, if we talk about alpha, looking at the review of cut-off bank statements for the period after the year end, this is normally done by the auditor in relation to the tests for determining if the reconciling items have finally cleared the bank. So this is not necessarily a subsequent events procedure. Similarly, Bravo and Charlie, talking about related party transactions and material weaknesses, are all procedures done during the testing phase of the audit and is not necessarily directed towards subsequent events. Moving on, we talk about the heading in the audit report that reads Report on the Audit of Financial Statements. So this heading, letter A, appears in all audit reports regardless of the opinion issued. Or letter B, appears only when the auditor has other reporting responsibilities. Or letter C, appears only when the auditor includes a going concern paragraph. Or letter D, appears only when the report includes an emphasis of matter or other matter paragraph. And to this, we recall as well our previous review where we said whenever the auditor has other reporting responsibilities, it will activate the subheading Report on Other Legal and Regulatory Responsibilities. And at the same time, it will cause the presence of the heading Report on the Audit of Financial Statements right before the first major section, which is the audit opinion. So this will appear only when the auditor has other reporting responsibilities. Moving on to the next question. In which of the following circumstances would an auditor most likely, highlight on the most likely, add an emphasis of matter paragraph to the standard report while expressing an unqualified opinion? This is a very wonderful point made with this question because it reminds us that the presence of the EOM and the OM do not actually have any effect on the opinion. So the EOM and the OM has no power to modify the opinion. So whatever opinion the auditor is giving, even when there is an EOM and the OM, these additional paragraphs do not change the auditor's opinion. So the question here is, in which of the following circumstances would we add an EOM to an unqualified opinion? Here are our choices. Letter A. The auditor is asked to report on the balance sheet, but not on the other basic financial statements. Or letter B. Management's estimates of the effects of future events are unreasonable. Letter C. There is substantial doubt about the entity's ability to continue as a going concern. Or letter D. Certain transactions cannot be tested because of management's retention policy. Now take note that what we are looking for here is a situation where we can still give an unqualified opinion, except that we add an emphasis of matter paragraph. So notice in the case of letter D, the inability of the auditor to test the transactions is a scope limitation, and so therefore could lead to either qualified or disclaimer of opinion. Similarly, if you take a look at letter B, being management's estimates are unreasonable, if the auditor and management cannot agree on the reasonableness of the estimates, this actually leads to a misstatement. This is what we call a judgmental misstatement. Judgmental misstatement is a misstatement still, and so therefore, this can cause the auditor to consider giving a qualified or adverse opinion. So we have stricken out letter B, Bravo. We have also stricken out letter D, Delta, because both of these would yield to a possible modification in the opinion. So therefore, we are left with Alpha and Charlie. Which one would activate the presence of an emphasis of matter paragraph? And the answer to this one is Charlie. The substantial doubt about an entity's ability to continue as a going concern would be highlighted with the presence of an EOM that points to a note in the financial statements that discusses this substantial doubt. Okay, in contrast, if you ask about or when you talk about an auditor is asked to report on a single FS but not the complete set of financial statements, this is an example of a separate engagement. And so, therefore, should the auditor wish to highlight this, then the auditor will make use of an other matter paragraph. So, the answer to this one is Charlie. Next, which of the following is not an audit procedure? We talk about inquiries, we talk about comparisons, completeness, and documentation. Of course, not an audit procedure would definitely be completeness because completeness is an assertion. And this particular assertion is present in both assertions related to balances and related disclosures, as well as assertions relating to transactions and events and related disclosures. So Charlie is not an audit procedure. Next question. Which of the following expressions is least likely to be included in a client's representation letter? Take note that we are looking for the least likely to be included. Starting off with letter A. According to letter A, management has made available all financial statements and related data. Letter B, management acknowledges responsibility for illegal actions committed by employees. Letter C, the company has complied with all aspects of contractual agreements that would have a material effect on the financial statements in the event of non-compliance. Or letter D, no events have occurred subsequent to the balance sheet date that require adjustment to or disclosure in the financial statements. Now, quite interestingly, of the four statements, three statements are valid statements of management's responsibility. For example, it is management's responsibility to ensure that the audit is not limited or hampered in any way. And so, therefore, letter A is actually a correct statement. We expect this one to be found in the representation letter. Management does not only acknowledge that they are responsible for the FS, but that they are also acknowledging their responsibility towards the audit. And that responsibility includes making available all financial statements and related data. Another appropriate or apt representation of management's responsibility is that which refers to letter D. When you talk about subsequent events, management is also the one primarily responsible for the identification and the proper accounting for said subsequent events. Similarly, it is also management's responsibility to ensure that compliance with contractual agreements are met. And so, therefore, Alpha, Charlie, and Delta are all appropriate management's responsibilities. What is the least likely here is Bravo. Because if you look at Bravo, it says management acknowledges responsibility for the illegal actions committed by employees. Of course, that will already be beyond the scope of management's responsibility. Management is not and cannot be held liable for the personal actuations and illegal actions of their employees. So that's why the answer to this is Bravo. Next, we talk about significant deficiencies. And when we talk about significant deficiencies, we recall that in our consideration of internal controls, we do have what are called deficiencies, then we have significant deficiencies, and material weaknesses. What is required to be reported in writing are both material weaknesses and significant deficiencies. So in this case, to whom shall these be reported? Letter A says the audit committee of the board of directors. Letter B says internal auditors of the entity. Letter C says management of the unit in which they occurred. Or letter D, creditors which the client has debt to. So I think in this question, we would already be able to strike out letter D, right? It wouldn't make so much sense for us to report the significant deficiencies to the creditors. So who should we report it to? The audit committee, the internal auditors, or management of the unit in which they occurred? The answer to this one will of course be the audit committee of the board of directors. So that should be alpha. So generally we say this will be reported to TCWG. Sometimes we say management and TCWG. But then we also have to recognize that TCWG can sometimes also be comprised of both NEDs or non-executive directors and EDs or executive directors. So TCWG, when we say they are comprised of EDs, that means that management and TCWG are one and the same. But in this case, it's very specific. We talk about the audit committee, and the audit committee must always have some external independent people manning it. Okay, so that's why the best answer to this is the audit committee. Next, we talk about analytical procedures, which are very popular in the conduct of an audit. We know that analytics can be done either in the planning, testing, or completion phase. And we also know that analytics are required to be performed in the planning and completion phase. In case of the testing phase, it is optional. So let's evaluate our choices. Analytical procedures are test of controls? No, they are not. Analytical procedures are not tests of controls. At most, they are risk assessment procedures and they are substantive tests, but they are not test of controls. So with that, we could already remove alpha and we could remove Charlie as well. So our choices are between letter B, substantive tests designed to evaluate the reasonableness of financial information, or letter D, substantive tests designed to evaluate a system of internal control. And we all know that substantive tests are not designed to evaluate a system of internal control. So therefore, the answer to this one is bravo. Next, which of the following procedures would an auditor most likely perform to obtain evidence about the occurrence of subsequent events? Is it letter A, inquiring of the entity's legal counsel concerning litigations, claims, and assessments arising after year end? Or letter B, investigating changes in stockholders' equity occurring after year end? Or letter C, confirming bank balances established after year end? Or letter D, recomputing a sample of large dollar or peso transactions occurring after year end for arithmetic accuracy. So I think the choices are trying to confuse us by ensuring that all of the choices refer to after year end. After all, subsequent events occur after year end or after balance sheet date, but before the date of the auditor's report. However, as what we have previously mentioned, one of the most common procedures in obtaining evidence regarding subsequent events is to send a letter of audit inquiry to the client's legal counsel. So therefore, the answer to this one is alpha. Then we talk about the auditor's signature, which we expect to find in the audit report. So the auditor's signature is letter A, in the name of the audit firm, or B, in the personal name of the auditor, or could it be C, both in the name of the firm and the personal name of the auditor, or delta, any of these are allowed in PSA 700 or ISA 700. And the answer, of course, is all of these are allowed. We do recognize that while these are allowed in PSA 700, using the personal name of the auditor, which is usually required by regulatory agencies in the case, for example, of the Philippines, like the Philippine Securities and Exchange Commission, but our standards are also quick to point out that using the personal name of the auditor includes what we call a harm's way exception, meaning to say that in rare instances where disclosing the name of the auditor would cause significant personal harm or threat to the life of this auditor, then they are exempted from disclosing their personal name and would therefore sign under the name of the audit firm. We also recognize that signing under the name of the audit firm is kind of putting the accountability on the audit firm, because when the partner signs in the name of the firm is acknowledging that it is also responsible for the said audit. So the answer to this is delta. All of these are allowed in PSA 700. Moving forward to the next question. What do we call a financial reporting framework designed to meet the common financial information needs of a wide range of users? This is what we know of to be the general purpose framework. So that is letter A. Next, in which sampling method is the probability of selecting an item proportional to the size of the value of the item? And I think simply by matching what is in the choices to the definition, we could already see the clear answer. This is, of course, probability proportional to size. This is sometimes called as value-weighted selection. Next, in case the prior period financial statements were audited by another auditor and the incoming auditor decides to refer to the other auditor, the incoming auditor's report should indicate, number one, that the financial statements of the prior period were audited by another auditor, and that's a yes. Number two, the type of report issued by the predecessor auditor, and if the report was modified, the reasons therefore, and that's also a yes. And number three, the date of the audit report, that is also a yes. So it's a big yes to all three, and we recall that these three statements will be disclosed in the form of an other matter paragraph. Next, the auditor found no control exceptions when performing statistical tests of controls over the client's invoicing system. Therefore, the auditor most likely, so we take note that there are no control exceptions. This means that the auditor has found the controls to be operating effectively. In short, the controls are effective. The internal control system is strong. Therefore, if the internal control system is effective, the auditor most likely, letter A, confirms 100% of accounts receivable. Letter B, expands substantive testing. Letter C, assesses control risk below the maximum. Or letter D, performs extended tests of controls. We get to recall that when control risk or when controls are effective, then the auditor assesses control risk as low or below maximum. When the auditor does this one, assuming inherent risk is also low, then this will lead to a higher acceptable detection risk, which would later on lead to less extensive testing. That being said, when controls are strong, all other factors remaining equal, then that means the auditor can go on chill or relaxed mode. So in this case, the auditor will assess control risk at below maximum. The answer can't be alpha, bravo, and delta, because these three choices represent a strict auditor. And in this case, what we're looking for is a chill auditor. So the answer is Charlie. Next, the basis for opinion paragraph is a section that is present regardless of the type of opinion issued. So even if the auditor gives an unmodified opinion, there will always be a basis for opinion paragraph. In case of a modification in the opinion, this section starts with the reasons for the modification, because it is, after all, the basis for modification section, the basis for, or rather, the basis for the opinion section. So this section starts with the reasons for the modification, and letter A says all of the choices below, so we'll evaluate that last. Letter B says in the case of adverse opinion, only includes a description of the modification. Or letter C, in the case of qualified opinion, ends with a statement about the sufficiency and appropriateness of evidence to support the qualified opinion. Or letter D, in the case of disclaimer of opinion, it ends with a statement about the sufficiency and appropriateness of evidence to support the disclaimer of opinion. Now, this statement that is mentioned in both Charlie and Delta is basically the statement that reads, we have obtained sufficient and appropriate evidence to support our whatever opinion. So in this case, if you talk about delta will be incorrect, because if the auditor disclaims an opinion, the basis for the opinion section only includes a description of the modification. It does not end with a statement about sufficiency and appropriateness of evidence, because in the first place, the auditor encountered a scope limitation with an effect that is so material and pervasive that we view the auditor as having been unable to actually perform the audit. So because the auditor was not able to perform the audit, then they couldn't have had gathered sufficient and appropriate evidence. So it's not delta. On the other hand, as what we have mentioned, in the case of an adverse opinion, an audit was actually done. An audit was concluded. The auditor was able to perform an audit, ergo, the auditor was able to gather sufficient or obtain sufficient and appropriate evidence to support the adverse opinion. So, in the case of the adverse opinion, it does not only include a description of the modification, but it ends with a statement about the sufficiency and appropriateness of evidence. And with that, we have just revealed that the correct answer is actually letter C. In the case of qualified opinion, it starts with the reasons for the modification and it ends with a statement that we have obtained sufficient and appropriate evidence as a basis for our qualified opinion. Let us now talk about Hall CPA. So Hall accepted an engagement to audit the 2025 financial statements of XYZ company. XYZ completed the preparation of the 2025 financial statements on February 13, 2026, and then Hall began the fieldwork on February 17. Must have been quite a quick audit because Hall completed the fieldwork on March 24, 2026, after which he completed the report on March 28, 2026. The question is, when should the client's representation letter normally be dated? Now, we know that the client's representation letter should be dated the same date as the auditor's report. So the bigger question now is, among these many dates, which one is the date of the auditor's report? And we would be able to narrow down our choices to either, let's just say, for example, February 17, 2026, the start of the fieldwork, March 24, 2026, the completion of the fieldwork, or March 28, 2026, the completion of the report. So, as a rule, the auditor may date the audit report as of the date of the completion of all essential audit procedures. Sometimes we call that one the date of the completion of the fieldwork, although this should not be taken literally as the last day of fieldwork, but it's the date of the completion of all audit procedures. Now, in this case, the audit was actually completed on March 24. But then, of course, we know what happens. There has to be a drafting of the report. There has to be quality controls on the FS that is to be released. And so, therefore, the auditor completed the report. The audit was completed on March 24, but the report itself was completed on March 28. So which one will be the appropriate date of the audit report? Is it the completion of the audit or the completion of the report? The answer is it should be the date of the completion of the audit. And so with this, the correct date as well of the client representation letter, which should be the same date as the audit report, is March 24, 2026. Let's now talk about Zero Corp. Zero Corp suffered a loss that would have a material effect on its financial statements on an uncollectible trade accounts receivable due to a customer's bankruptcy. So, unfortunately, one of Zero's major customers was declared bankrupt. This occurred suddenly due to a natural disaster 10 days after Zero's balance sheet date, but 1 month before the issuance of the financial statements and the auditor's report. So to this, we could already readily identify which type of subsequent event this is. As of balance sheet date, this customer had no financial difficulties. So meaning to say the subsequent bankruptcy of this customer did not exist as of balance sheet date. And with that, at most, this will be a type 2 subsequent event, which will only require disclosure but no adjustment. So with this, when we evaluate, number 1 is a no because there will be no adjustment. It's only a type 2 event. Number 2, the event requires financial statement disclosure but no adjustment is a yes. So we have identified number 1 to be a no, number 2 to be a yes, and number 3, the auditor's report should be modified for a lack of consistency, and it's a no. There is no consistency issue here. It's only a matter of a subsequent event. So it's a no, yes, and no, which would refer to choice B. Bravo. Next, an auditor is concerned with completing various phases of the examination after the balance sheet date. This subsequent period extends to the date of the letter A, public issuance of the financial statements, letter B, auditor's report, letter C, final review of the audit working papers, or letter D, delivery of the auditor's report to the client. So again, when we talk about subsequent events, these refer to events occurring after balance sheet date but before the date of the report. So the answer to this one is letter B, Bravo, auditor's report. Next, if an auditor wishes to draw prominence on a key audit matter, they should. This is a good question. How should you highlight a CAM? And to this, we are reminded that items or matters that are under the key audit matter section should not, I repeat, CAMs should not be the subject of an EOM nor an OM. Okay, so if it is CAM, then it is CAM. It's exclusively CAM. It cannot be CAM and EOM at the same time or CAM and OM at the same time. That is not allowed. But what if you would like to highlight a certain CAM? How will you do it? Letter A says, do it by adding an other matter paragraph to highlight the key audit matter. And to that, we already know letter A is not the correct answer. Letter B, do it within the basis for opinion paragraph. But then we also recall that only those matters which are powerful enough and significant enough to make the auditor change his opinion or to lead to a modification of the opinion will belong to the basis for opinion paragraph, right? CAMs, like CAMs which do not modify the opinion cannot get inside the basis for opinion section. They remain within the CAM section. So it's also not letter B. To draw prominence to a CAM, according to letter C, the auditor should do it within the CAM section. And this is actually the correct answer. So if the auditor wishes to highlight or draw prominence to a CAM, maybe the auditor can place it first amongst the list of CAMs that will hopefully draw prominence. But we are reminded to do it only within the CAM section. It cannot be the subject of an OM and it cannot be the subject of an EOM. That is also what makes letter D as wrong or as a wrong answer. So the correct answer to this one is Charlie. And that's it. Can you believe it? If you have been following our playlist for the MCQ Marathon, this officially means you have reached the 100 question mark. So bravo to you. Congratulations. You have just effectively answered 100 multiple choice questions for auditing theory. Now my question is, are you ready for part 5? But here's the deal. Because you have answered 100 questions already at this point, I have 2 bonus questions for you. Just as my way of telling you, good job, congratulations, you have 2 bonus questions. And this is your first bonus question. Which of the following characteristics most likely would heighten an auditor's concern about the risk of material misstatements arising from fraudulent financial reporting? And to this, we recall that when we talk about fraud, there are actually 2 categories of fraud. There is what we call fraudulent financial reporting, and there is what we call misappropriation of assets. So, whereby misappropriation of assets would refer to more of the action-filled types of fraud like embezzlement of funds or stealing of inventory. Fraudulent financial reporting, on the other hand, refers to what we commonly call as window dressing. So, of these 4 choices, which of the following would most likely heighten your concern about possible fraudulent financial reporting? So let's evaluate the questions. Letter A says bank reconciliations usually include in-transit deposits or deposits in transit. Letter B, equipment is often sold at a loss before they are being fully depreciated. Letter C, the entity's industry is experiencing declining customer demand. Or letter D, employees who handle cash receipts are not bonded, meaning there is no cash bond for these employees. So again, we recall that we are talking about fraudulent financial reporting. When you talk about the presence of deposits in transit or even losses or selling equipment or machinery at a loss, more often than not, these are transactions that relate to the regular or normal transactions of the business, right? So we could already at this point strike out Alpha and Bravo. We are left with Charlie and Delta. Delta refers to employees who are not bonded. But if you think about this one, this is more relevant to what we call as misappropriation of assets or embezzlement of funds. Because the employees are not bonded, then they may have that extra boost of confidence to embezzle the funds. And so therefore, while Delta may be an alert for fraud, but this is more for fraud arising from misappropriation of assets. We are concerned with fraudulent financial reporting, and so therefore the answer to this should be Charlie. When the business or the industry is experiencing declining customer demand, this might provide an added incentive or pressure for the business to window dress their financial statements to make it appear that they are better off than they actually are in the presence of this declining customer demand. So the answer to this question is Charlie. Next, what do you call the difference between the tolerable exception rate and the estimated population exception rate? So, tolerable exception rate versus the estimated population exception rate is called letter A, accuracy of the initial sample size, letter B, inflation factor of the initial sample estimate, letter C, precision of the initial sample estimate, or reliability of the initial sample estimate. Now, this difference is actually called precision of the initial sample estimate. So again, when you talk about the difference between tolerable versus estimated population exception rate, we call it precision. And there you have it, your two bonus questions. Once again, a big congratulations to you guys if you have completed our MCQ Marathon playlist up to this video, up to this point, and you have already answered 100 questions plus two bonus questions, make that 102 questions. Good job, you guys. And so now I do have to ask you the question, are you ready for part 5? Or perhaps you might want to take a short breather or a short rest. I hope that you stay tuned for when we are able to upload already part 5 and the rest of the series. Again, all in an effort to help you prepare for your examinations. So once again, good luck guys and see you in the next marathon.